If you're selling your bags on Grab, I'm grabbing them, bagging them, and putting them in the filing cabinet. This company is absolutely undervalued. And what this company is doing right now, top notch. And I actually believe that they are an $8 fair value on this company. And we're going to get into that. We're going to get into how I just bought 100 leaps in this name. We're going to talk about their recent Q4 earnings. We're going to talk about what the company is, what they actually do. Then we're going to get into my high five snapshot. We're actually run through the projections, run through the company's numbers, and we get to our buy, sell, or hold rating. And just to make this brief for some people that don't have time, that don't want to stick around here for the whole video, I do believe that Grab is an intrinsic value or fair value of $8 per share. So we're going to get into that. We're going to get an EPS, revenue growth. We're going to get into the numbers. And then finally, we are going to talk about the charts and what I'm seeing on the monthly and the weekly on Grab. So let's get into it. So, like I said, I just bought 100 leaps, which is essentially about 2 years out from now and a little less than that. But so Jan 15, 2027, $5.50 calls, limit of filled at $1.79 for $17,967.68 is what I bought today. That's the equivalent of if I exercise these, if they were in the money, if I exercise these, this would be about 10,000 shares. And it's about, if I bought the equivalent of this amount of shares, 10,000 shares, it would be about it would cost me about $50,000. So I basically cut that in almost a third to what I actually had to pay to get this amount of shares. So this is a half position build for me in my high five investing portfolio, and yeah, I'm really bullish about everything I'm seeing so far. So let's get into the Q4 earnings, just some things that I saw that I wanted to highlight. So this I love presentations because they just give you the the meat and potatoes of what took place and what are their highlights. So revenue growth of 17% year over year, and then on-demand gross merchandise value was 20% year over year. Group adjusted EBITDA was $97 million. Profit for the period was $11 million. And adjusted free cash flow was $61 million, $60 million year over year, plus $60 million. So they added $60 million. So then we talk about 26% penetration of Saver transport rides across the region, proportion of new MTUs who join the Grab platform through Saver transport rides, and then 1.5 times higher average transaction frequency Saver transport users versus non-Saver transport users. So they're basically getting on this subscription model, and I love it. I love SaaS companies. It's recurring revenue, and it's very easy to forecast these types of things. You see Uber and Lyft doing these things as well here in America. 2.2 billion total loans dispersed across GrabFin and Digibanks. So the thing you know about Grab, it's not just about food delivery. It's they do so much. They do finances, they do food delivery, they do ride hailing. It's kind of an all-in-one company in Southeast Asia, which is just really crazy. So they're like the tech giant of Southeast Asia, and that's the bullish thesis of this company, is that they will be the tech giant and the leader in that Southeast Asia space, and they're gonna run it. 20 basis points year-over-year reduction in net cost of funds, plus 64% year-over-year growth in loan portfolio, $1.2 billion in total deposits across GXS Bank and GX Bank. 9 in 10 GX Bank customers are users in the Grab platform, and less than 2 times year-over-year growth in loans dispersed. Just some other cool little features here. And then we get to the financials, which we don't need to get into right now, just because I already have everything updated in my spreadsheet, in my high five snapshot. So we'll get into it there. Just want to give a brief overview. This is Seeking Alpha's new Analyze with AI. It's a pretty cool little feature. It gives you like their little strong buy rating here with their quant. And then essentially it gives you like, the company. So market cap of 19.27 billion and EPS growth and PE EPS growth is not measured because they're not. Actually, I don't know why it's not measured, but they have 146 PE right now. We'll get in all that, like I said, in the snapshot. And essentially, they're headquartered in Singapore, founded in 2012. These are all the countries they cover. Like I said, Southeast Asia. And essentially, the company offers a comprehensive platform that integrates mobility, delivery, digital financial services, and enterprise solutions, serving both driver and merchant partners and consumers. Grab Super App ecosystem allows users to access ride-hailing services, food and grocery deliveries, and financial services like digital payments and lending. The company is recognized for its strong market presence, particularly in the online food delivery and ride-hailing sectors across the region. Grab's significant milestones include the acquisition of Uber's Southeast Asia business and the expansion into digital banking with GXS Banking in Singapore and GX Bank in Malaysia. The company continues to innovate and expand its offerings, aiming to enhance digital engagement and economic empowerment in the region. These are their competitors, C-Limit, GoCheck, and Foodpanda in different services, obviously. Seeking Alpha Quant rating explanation. Grab is rated strong buy. The company demonstrates impressive growth, very good profitability, strong stock momentum, and encouraging upward revisions of future earnings estimates. The valuation is somewhat stretched, but the positive factors outweigh this concern. And what I'm going to show you today is going to show you that, again, I believe it's an $8 fair value company, and I'm going to show you exactly why I believe that. Valuation's a B minus, growth is an A plus, profitability is an A, momentum's a B plus, revisions are a C. And then get into some valuations, growth and stuff here. Summary. Grab demonstrates outstanding growth metrics and high profitability supported by strong stock momentum and positive earning revisions. Despite a somewhat stretched valuation, these strengths underscore its strong buy rating, reflecting confidence in its continued performance and potential. So, we got through all that. Now let's get into what I actually truly how I truly value a company, and that is essentially through my high five snapshot. If you missed the video on Oscar going over my high five snapshot, definitely go give that a watch. Really good video in my opinion, and really thorough, and why I believe Oscar is just an immense opportunity and crazy undervalued. But we're talking about Grab here, so just the basics here. Current price, 52-week high, 52-week low, market cap, and essentially we're just going to go through the main points, right? So you have your free cash flow margin rate. Your free cash flow margin rate for the next 1 to 5 years. This whole thing is a 10-year analysis and 10-year projections taken into consideration. So we have a 1 to 5 year free cash flow margin rate. Right now, today, they're doing about 27% or 28% free cash flow margin rate today. Not on their adjusted free cash flow, but on their actual unadjusted free cash flow. What their actual free cash flow is, not the adjusted one. So the unadjusted one, they're pulling in about what was it? It's like 7. Yeah, I put it here instead. Whoops. They're pulling in about $704 million in free cash flow as of right now, and they're just starting to flip to profitability starting this year, honestly. So we have I bumped it down a little bit just in case they lose a little bit of that, but essentially we're doing 25% over the next 5 years for the free cash flow margin rate, and then bumping that up to 30% over the last 5 years of this total analysis. We're giving them a terminal value, which essentially is saying what is their free cash flow margin, just like a PE that you would give them at the end of the 10 years. I'm giving them a 20 because of their dominance, and I believe their continued dominance in that sector, in the Southeast Asia region, right? And they're still going to be growing 10+% over that last 5 years. So I still believe they deserve a 20 PE for a company that's going to grow into a tech giant in Southeast Asia, and basically, have that whole region to themselves for now. But I think for continued in the future, because they've been there, and you get people on board with your apps, and you create that really sticky business model. Revenue is about 2.8 $1 billion trailing 12-month revenue after this recent earnings. And then we have free cash flow of 702 million, like I said, and we have net cash and net debt ratio and difference of 625 million to the positive side, and we have 4.04 billion shares um, out in the world right now. So our free cash flow yield and our 12-month or forward free cash flow yield is 3.64% and 3.63%. And essentially, this is telling you that, and you want to see this above 3, honestly. And this is just telling you the return on your investment, essentially per share, how much of that free cash flow you're essentially getting of the actual company. So for 4.79 for $4.79, you're getting 3.64% of that, basically due to the free cash flow yield. And then your PE, they're kind of out of whack right now. It's because we have a negative 3% EPS for 2024. And then in 2025, we are expected to bump up to 5 cents per share on the EPS. And that obviously brings us up to about a 96 PE. And again, on the PE side, they have to grow into their valuation. But on a free cash flow, as you can see here, they are a buy right now. And Warren Buffett, the greatest of all time of investors, loves this discounted free cash flow model. He loves being able to understand the free cash flows of the company. And that is, the lifeline of the company. If you have cash, you could do so many things with it. You buy back shares, you could pay out dividends, you can pay down debt. There's just so many things you can do with that free cash flow. You can invest in yourself. There's so many things you can do. And free cash flow is the lifeblood of the company. And I've learned, in my over 10 years of investing and trading that you can't just look at a PE and then just say, well, this company's not for me. It's not going to be it. That's not how these things work. You got to look you got to look a little deeper. Our PEG ratio, because we're supposed to grow 250% in 2025 this year, so our PEG ratio is 0.64 for 2025 as well. And getting to the discounted cash flow model, again, we have an intrinsic value or fair value of $8 per share, which is giving you a current margin of safety from today's price of $4.79 of 42%. Now, this isn't a double up, but it's close to it, right? If we do get down to where we may go on the charts that I'm going to get into next, then we could see a double up in this name, because I do believe we might be able to get down to $4 per share, but we just have to see. So right now we do have a 42% margin of safety. Already went over the factor grades. This is the free cash flow, as you can see, as it's modeled out. This is the revenue growth, as you can see, that's modeled out. 19% for 2024, and then in 2026 or 2025, we had a 21% revenue growth, and we we projected 16%, 28%, and then dropping down to low teens for the rest of this 10-year analysis. And this little margin of risk price overvalued, essentially right here, is something that I created. And it's just like your inverse of your current margin of safety. And this just kind of tells you, if we get up into these territories, you should trim 10, 20, 30, 40, 50, 60% of your position, because, we're getting into overvalued territory. But I only look at this if I give it like a higher PE than what I believe. So if I give it kind of a 30 PE, which I don't believe it should be at, then and we start hitting these numbers, so in the teens and in the 20s eventually, then essentially, yeah, okay, I'll look at it and say, it's time to start trimming this name. But if we don't get there, then I'm good with it. And here's the thing too. So like 16 and then 28%, if we start bumping these numbers up, I do believe they could get and stay in like the high teens. So 20, and then let's just say they get to 18, stay at 18, then 16, then 14. You see, we get up to $10 fair value. So you can mess around with these numbers in my high five snapshot and really start seeing some crazy gains in here. But it just all depends, obviously, of your analysis and your projections. These right here are honestly just analyst projections, and I just make sure that they're not crazy. And then I'll make them more conservative, because I want to buy being more conservative than being way out in left field. And then finally we get to our EPS, and essentially we have obviously 3 cents of a loss. And then this year we're supposed to hit a 5 cent gain for a 250% year over year upswing with a 30 PE. Again, they're right now like 100 and whatever I said last. It was like 130 or something like that PE. And then we jump up 147%, and then we keep climbing higher on EPS, getting to a 2034 EPS of $1.19, which gives us an average EPS growth rate of 25%, and gets us we have our PE 30, and then we drop to 25, 20, 15, and then 10. This PE could stay at like 20 for longer, or maybe bump it to a 25 if we see consistent 15% to 20% revenue growth. So somewhere in there, high teens, then this could definitely be a 25 PE this whole time. But even at these more conservative and what I believe where they're actually going to be growing, then obviously we see that in 2027 we're actually going to have that fair value that's higher than the current price in 2027, and we have a 12% return on investment. Obviously, if we run like we should with the free cash flow, then obviously this could change, but also could the EPS growth rate and the PEs that you assign it. So again, this is just a projection, but that's what I'm seeing on my high five snapshot. Now let's get into the final thing here. Let's get into the actual charting, the technical analysis using my high five trading strategy and my Williams consolidation box trading strategy. So as you can see on the chart here, we have grab, we have a massive consolidation down here on the monthly, and then we have actually broke out of this monthly consolidation here, as you can see, and now we have come up, hit this basically cup and handle that we have formed, and now we are forming the handle of that cup and handle. And essentially, we're just consolidating in here. But when we break out, this was a false breakout, but also just hit this resistance here. So this is resistance right now. Once we break out over this, then we are going to see that ascent higher in continuation up to that $9.30 marker. And that is actually our measured move. Our measured move is from the bottom of the cup and handle to the top of the cup and handle, measured to the breakout of the cup and handle, and up to here for 61% higher for $9.30 from the breakout point, not from the actual point here. And as you can see, this little green indicator that's red and then green, we actually have this bullish flip on the indicator. We had our buy signal back here. I did not buy there because I was not aware of this company, and I did not do my DD on it yet, but I'm aware now. And so we had this buy signal, and then since then we kind of consolidated, and then we had this breakout to the upside. So we got our buy signal, and then we got our bullish flip. As you can see back here, we got this bullish flip, green through the smoothing line. So we had our bullish cross, and now we are continuing higher. And our high five indicators right here, it's my personally coded indicator of my strategies. And essentially it's right here. And I believe that's going to support the stock as we continue to climb higher. So I can see it come down to about, this area right here, right where the indicator's at. So about $4 to $4 and, 50-cent range, essentially. I can see it come down there and then have a nice bounce, and you would essentially also be bouncing and retesting this consolidation period, as you see. So high five is good and telling us that we are good to stay in this name for the long term, and it should ride us higher. If it does flip over, then that could be very bad. But at the same time, we do have less risk, in my opinion, because we have this volume shelf and we have all this consolidation here. So it'd be very hard to break below this consolidation. Finally, I'm going to talk about my Williams consolidation box strategy. So essentially, we have our green barrier down here where the company started. It started on the green support beam. It started down here. This is the Williams percentage range. Started down here, and then once we curled up and started moving, you see that the stock started moving higher, right? And then essentially we hit our red barrier, and it didn't have enough to continue to grow, so it didn't create a Williams consolidation box and continue higher. What it actually did was broke down, started its descent down here, came back up with a fake out, came back down here, and just essentially double bottomed right here on the Williams percentage range. double bottomed, and now broke back up. It came up to the red barrier, bounced off of that, came down. We just created support on the Williams percentage range, which essentially for the Williams consolidation box, you come up here, you bounce off the red barrier. Wherever you stop, that's above -50, you create support, and then essentially you have your box. And then as long as we continue to stay sideways within this the confines of this box, then this stock price will continue to climb, as well as the high five indicator continue to climb and support it. So those are my two strategies: the high five indicator and the Williams consolidation box that I use to trade, but I also use to invest on a higher time frame. And if you want access to either, we're starting up, some investing stuff right now, and sharing my portfolio. Going to get into that in the high five trading community, and it's not going to be the high five trading community for long. It's going to be the high five community, because it's going to include investing as well. So it's going to be an all-in-one place. It's going to be where trading and investing meet. It's going to be using, my trading indicators and my trading strategies to help support my high five snapshot and fundamentals, and pick stocks that have the highest probability of doing very, very well based on the fundamentals and based on my strategies and the technicals, right? And I also use my high five snapshot and my fundamentals for my, weekly and daily trading. Well, really my weekly trading, my long-term trading. I use my fundamentals and my high five snapshot for that as well. So if you are interested in joining a community of over 60 members, amazing members from all over the world, I love them all. They're so amazing, and they're so engaging, and they truly want to learn and become better at trading and investing. If you want to join us, if you do, don't care. If you do though, here's the link right here. And yeah. So getting into the last thing I want to talk about on the weekly chart of Grab, we have again this consolidation sideways, and we have our, basically our breakout, and this could be our retest, just a little higher, but we did wick off here and have resistance. So that could be your retest, right? But if not, then essentially you could see this higher or lower high forming, and then a move down here, like I said, to about $4 to $4.50 mark, because also you have this downtrending Williams percentage range. And this downtrending Williams percentage range essentially could either come down to the green barrier again, or it could just have said, well, we hit this -80 like we did here and like we did here essentially, and this is going to be it. This is the last stop for the train, and now we just made a higher low. If we close this week out here, which I think we will, we made a higher low, and then we can continue higher, obviously building off of this higher low right here and continuing back up here. And we want to see it climb back up here and then get in another Williams consolidation box like this. And if I can do that along with the monthly, then not just on a longer term time frame like with the monthly, but also on a little bit of a shorter term time frame like weekly to a couple months, we could see Williams consolidation box form and us really start to ascend up to this $8 and $9.30 area. Again, I'm not expecting us to get to $9.30. We could reach that this year. If I'm being totally honest, we could. But typically, I don't put time frames on these things for investments. I just, get in when I think it's undervalued, and I ride it higher, right? So short term, I think we could see definitely in the 6s and 7s for short term if the markets play ball. If they don't, or we do continue down here, then we could see, just low 4s. And then I believe that would be a good dip buying opportunity, and I would actually buy more leaps and possibly shares at that time. So that's Grab, everybody. Really appreciate you sticking around this whole video. Again, if you want to join a community, it's right here. No pressure. If you do, you do. You don't, you don't. It's all good. I appreciate everybody following. I appreciate the subscribers, the followers, and appreciate if you like this video, and let me know down in the comments if you appreciate and you like this type of content. That way I can keep making it. And drop a comment below on any stocks that you want to see run through the high five snapshot, or you want to see my technical and fundamental analysis on. If I get, a stock that everybody keeps wanting to see, then I'll definitely hop on that. Or if it's something that I've already done my snapshot on or looked into, then we could definitely look into doing a video like this for that. Awesome, guys. I really appreciate it, and I hope you have a great rest of your day and a great weekend. Talk to you later.